Gary, hello.
Hi, Leo.
Gary, it's been a while. I've got three questions that I'd like to put to you. Number one, igniting an investment big bang. Private equity's been buying a lot of UK listed companies recently. How did you respond to the letter that you received from the Prime Minister and the Chancellor of the Exchequer?
Well, they're on the right lines in trying to get more money into investment in the UK, and they are encouraging institutions to commit capital to long-term projects as opposed to engaging in short-term money making. And so I commend them, and I think that they're trying to get the economy going the other side of a nasty pandemic, which has caused obviously a tough recession in 2020. I've got some issues with it. It's a good letter, but they are especially trying to encourage defined benefit pension funds to invest in long-term, let's say less liquid assets. But meanwhile, the pensions regulator is trying to encourage pension trustees to de-risk, and the two don't go hand in hand. So it's almost as if the government is pushing the accelerator and the brake at the same time. So I think they've got a bit of work to do on that, and I think they need to give pension trustees a very, very clear message that they are in favour of those trustees taking long-term decisions with the capital, as opposed to simply trying to hedge out all risks, become less reliant on the employer, and spend their money buying government bonds, which in my book isn't the way forward, particularly at current yields.
Mm-hmm. Gary, thanks. Moving on to the second point. Four words for you. Interest rates, inflation and unemployment. What can you tell us about those?
Let's do them in reverse, shall we? Unemployment is on the way down. Job vacancies are at record levels. Anyone wants to have a look at the ONS report on the job situation at the end of July, it's extraordinarily encouraging. There's over 900,000 vacancies. That's a massive increase even on pre-COVID levels. So that's really good. Interest rates are kind of been tracking down recently. I don't mean base rates, I mean long-term bond rates, which are the ones that really matter to the economy. And inflation's began to ease a little, which means that the argument that the higher inflation figures that we've had through the summer, stimulated really by a lot of people trying to get back to normal and suppliers struggling to deliver all the products and services within existing resources, looks like it is transitory. And that would be our argument. You know I've been warning about inflation for some time, but I wouldn't want anybody looking at this to think I'm in the camp of saying we're going back to the 1970s. We're not going back to the 1970s. My argument has been for some time that inflation and interest rates are going to revert to their long-term means, and that's a disaster for holding long bonds. So all these things at the moment, Leo, are extraordinarily positive. We've got a wobble in the economy at the moment because there's a concern about the coordination of worldwide GDP growth, and I think some of the things that the Chinese government have done recently doesn't look good for the economy. But overall, I think things are looking extraordinarily positive. You've just had a big quarter, over 4% growth, for goodness sake. That's extraordinary. And these job figures tell you just how much demand there is that's built up within the economy. So I am very optimistic at the moment. It's looking good.
Thanks, Gary. Well, I'd like to move on to productivity, if I may. A few stats I've seen is that it rose briefly in Q3 last year. Q1 this year, it's dipped a little, but there's a flash forecast that it's going to rise again this quarter. What are you seeing?
Well, you probably the reason it rose last year was just it was artificial. If you think about this, the productivity level of people working in restaurants relative to, say, someone working in high tech is quite low. And which sectors did we shut down through the pandemic? We shut down the lower paid sectors, and that then artificially boosted the productivity figures. So it is a blip, and you referred to it as such because you've seen the chart. I'm sure it comes back down again. There's no evidence to suggest that we've dealt with this productivity problem, and in fact the letter that we got from Boris Johnson and Rishi Sunak indicates that, because they're obviously concerned about the productivity, as we all are, and they want it to pick up. But it's not all negative, and I am going to cover this in some detail when we do the seminars in December, which fantastically looks like they're going to be face-to-face live, so that's going to be terrific. But I think part of the productivity problem is not everything that is valuable is getting counted in the economy. And I am more optimistic about productivity going forward over the next 10 years than the figures have shown over the last 10. Although that improvement was a blip, it doesn't mean the long term is negative. And I think on the whole, the future is very bright for our economy right now.
Thanks, Gary. That's what I was going to say in summary. And how do you think that'll reflect in the funds and the strategies that you've got in place and incoming?
Well, we've positioned ourselves to be in the things we think are worth holding and that we can buy at reasonable values, and simply will not start buying stocks on massive multiples. You know, anyone who's been tracking these or looking at the things that I've written in the past few years know that paying 35 times earnings for the big five isn't my idea a lot of fun. So the argument could be, so you've missed a lot of that. Yes, we may have missed a lot of it, but look at some of the other things that we've done well on buying at the other end of the scale. In my book, we take on less risk and we've got good returns, and we got awards for those results again this year. So it's all been really very, very good. But there's no appetite on the investment team for suddenly buying up the very expensive ICT companies. So no, I think there is good value there, Leo. You can get well positioned with decent businesses, with good cash flow, decent benefits, decent balance sheets, good earnings, and you're not paying an arm and a leg for them.
Thanks, Gary. I did say 3 points, but I threw in a bonus at the end, so thank you very much for answering.
Yeah, let me just say one other thing on this issue, because I know this comes up regularly on these multiples.
Sure.
You know, at different times, different companies end up as the biggest companies in the stock market. You know, IBM have been up there in the past. Standard Oil have been up there in the past. Where are they now? It changes. And the worst decision you can do is buy these big companies at very, very big multiples. Now, one of the headwinds they've got coming up is regulation. Look what China's done to some of its tech companies recently. Xi Jinping is simply not going to let them have the same latitude that they've been granted in the States, but it will come. Regulation catches up with innovation eventually. But I wouldn't want anybody to think just because we're negative at paying 35, 40 times earnings for these companies, there's not lots of other good opportunities, and there are. So we're very optimistic, but we're going to do it in the right way.
Thanks, Gary. We'll keep tabs on that then. I'll leave it there for now. We're hitting on almost 10 minutes, so hopefully the audience is still with us, and I'll catch up with you again soon.
Great. Cheers, Leo. Bye.
Thanks, Gary. Take care.